Hello ladies and gentlemen, welcome back to the channel. In today's video we are going to be starting off a new series that I really wanted to make on this channel that I'm calling Finance 101. What we're going to be doing is covering the real basics of finance and personal finance and retirement and things such as that, just to help everybody who is either new to investing or wanting to learn more about investing or finance as a whole, learn some of these basic things before they kind of get introduced to the world or go further in the world of finance. I really think this is something that's important for not only financial majors, or if you're going to work in finance, but also people like everyday people. You may see simply because of the fact that finance and personal finance is so important for if you're planning on retiring, for having a strong base when you retire, and just being able to budget and create all these different things that will help you further on in your career and in your life. So today we're starting with, if you guys couldn't tell from the screen we have here and from the title of this video, what is a stock? Okay, this is a very simple, if you will, but simple concept, but there are some complexities to it that we're going to kind of dive into here and kind of break it down on a basic level, so hopefully everybody can understand. So let's get started. What is a stock? Stock of a corporation is all of the shares into which ownership of the corporation is divided. Now what that means is when a company goes public, there are private and public companies. When a company goes public, they send out shares of their stock, usually via an IPO, which is an initial public offering offered by an investment bank or even on their own, like Spotify did here recently. They break their company into shares. A lot of those shares stick with the founders and the whether it's like the CEO or CFO. Large portion of it goes to those members, and they still own the vast majority of the company. But let's say 10% of the company is broken up and put into public shares that are then distributed to the whole stock market and to investors, everyday investors like you and me, so we can now purchase part of that stock, part of that company, and potentially have some ownership rights to it. We can vote, we can earn things such as dividends, we can earn the growth, and these are all things we're going to cover later here in this video, but that's kind of the basics of what a stock is. Let's take a look at one of the most famous companies in the world today, and take a look at their stock. This is Apple stock, ticker symbol AAPL. If you don't know what a ticker symbol is, it's usually the letters attached to a stock. Obviously here's the name, if you can see my cursor, and then here's the ticker symbol. It'll usually be, this is Yahoo Finance, it'll usually be to the right of the name. AAPL is Apple's ticker symbol. Usually it's very related to the stock as a whole, but then you have certain companies that just they pick whatever. I know the Cheesecake Factory, their ticker symbol is cake, which obviously is directly related to it, but you could have a stock that's name is like industrial whatever, and their ticker symbol could be like rug or something like that. It's really whatever they choose if it's available. And then as you guys see, it's on the NASDAQ real-time price. Obviously today is a Saturday, at close on Friday, September 25th at 4 p.m. That's when the stock market closes, and we'll probably have a whole separate video on like the intricacies of the stock market or the basics of it as well. So here you see this number here. What that number is what that stock is currently being traded at. Currently Apple is listed at $112.28 per share. Then you look to the right of it, you see either a green or even a red number. There's been a lot of red in the stock market recently. What that means is if it's green, the stock market went up during the day, as you guys see, plus 3.75%, or plus $4.06. So this percentage is going to be a percentage of this number here, the stock price, and if it's red, obviously that means it's going to this will be a negative sign, and it will be down whatever percentage it is on that day. So that's something to keep in mind here. This is what your basic stock looking at a stock through either Yahoo Finance or a Morningstar, or even if you just Google Apple stock, it'll pop up and look something very similar to this, usually with a chart attached to it. So these are like the very basic things to look at when looking at a stock. And this is how much one share, once again, how much one share of a company will cost. It could be $1 or it could be $3,000 when you look at something like Amazon or something like that. It's really up to the company. It's really up to how many shares of that stock are out there to the public, and whether they want to split those shares to make more, or whether they want to kind of keep it in that limited club like companies like Amazon do, just because there's such a high growth, and potentially they may split that share eventually as well. So there are two main kinds of stocks. First of all are growth stocks. And what a growth stock is any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. So the average growth for the market is usually right around 8% a year, maybe 7% if you're being more conservative. So a growth stock is going to be projected to beat that. You know, you could see potentially 10 or 12 or 20% growth if it's doing really, really well. And obviously that does beat the average 7 or 8% in the market. But the problem is there's going to be potentially more risk involved right here. And you see a term listed as beta. This is something you'll see a lot of in like a Yahoo Finance or a Morningstar. It will be listed with these stocks. And what beta means is it's how risky a company is compared to the stock market as a whole. The beta of the stock market, or the S&P 500, is 1. So you can see companies with 0.5 betas. That means they're half as risky as the stock market. And you can see companies with 2 betas, which means they're double as risky as the stock market. They're twice as risky as the stock market. So that's definitely just something to look for. And we have some examples of these. We have Tesla, Amazon, and Netflix are 3 great examples of growth stocks. Usually growth stocks aren't going to pay dividend because they're usually just going to put that money back into the company. But Amazon and Netflix do pay dividends. It's just a very minimal amount. Tesla is probably the best example of a growth stock currently. Since we talked about beta, Tesla's beta, I believe, is like 2.5. So it's 2.5 times as risky as the stock market overall. So that's something to look at and something to know when you invest in it. So if you're investing in a really risky company or a really risky growth stock, you're going to want to see those returns. And obviously Tesla, they've at least quadrupled, if not more than that, in their value over the course of this year. I mean, I think it's more like 700 times. Or 7x, whatever I should say. They've done really well. Obviously, they're struggling here a little bit, but obviously that's going to be what you want from a growth stock. You're going to want to see that kind of growth, especially if the company's more risky. Now, the second kind of stock I want to cover is value or dividend stocks. And what these are, a stock it's a stock that trades at a lower price relative to its fundamentals. And those fundamentals could be dividends, earnings, or sales. So you could see these things as like, say, Bank of America is always listed on these. Say Bank of America is trading at an PE ratio, which is price to earnings ratio of 10. Usually that means it's pretty undervalued. Usually a PE ratio, if it's priced pretty correctly, would be about 20. If it's anything under that, you're starting to get into a really good deal. So that would be more the value side. I tend to look at these value/dividend stocks more of the dividend side as a way of steady cash flows. As you guys can see there, steady cash flows. So this is what I like. I like mixing my portfolio up with not only great growth stocks, but also great dividend stocks, which create these cash flows, whether it's monthly, quarterly, or semi-annually, or even once a year. You can potentially make some money and have some sort of income coming in, whether you're in the middle of a recession, or whether the stock market's booming and you're just not selling your shares because it's doing so well. You could still potentially see that dividend coming in. And what a dividend is, it's usually a quarterly payment by a company, and it's set, say it's like 2%, and the company is trading at $100 per share. That 2% dividend is over the course of the total year. So if it's 2% of 100, that's $2. And you're going to make about 50 cents per quarter. So that $2 is divided up over the course of that whole year. And obviously, you know, that's nice to see. And if you own multiple shares of it, say you own 5 shares, that 50 cents is going to be multiplied by 5, and you're going to earn 5 times what you would have if you only had the 1 share. Some examples of this are Coca-Cola, Waste Management, and AT&T. You're not going to see any great growth from any of these companies. Otherwise, they'd be listed as a growth stock, but they do pay strong dividends, and these companies aren't going to go out of business. Coca-Cola, been around forever. Waste Management, if you don't know what they are, they do a lot of the trash and disposal. They'll pick up your trash weekly, and obviously that's something that people will always need. And then AT&T, just a really good internet provider, cell phone company, whatever you want to call them. Really good at what they do. They pay a great dividend, and these are all usually pretty safe companies. Even in a recession, these companies will potentially, especially like a company like Coca-Cola, will potentially pay a dividend to you, so you can still have some sort of a cash flow coming in, especially if your portfolio is being slammed by all the red and all the down days on the market. So why do people buy stocks? You know, there are 2 different reasons, and they kind of fall into the 2 different categories we saw here. Growth potential would be for the growth stocks. Obviously, you know, you want to, if your money, I guess we should say, and then steady cash flows as well. If your money is just sitting in a checking account, you're not going to earn any interest on it. Why not put that in a stock that could potentially earn you 8%, or an index fund that could potentially earn you 8%, whatever it may be, or a stock that could potentially earn you 15%. Why not potentially take that chance if it is a good company, if you know the ins and outs of the stock? That's where that growth potential comes in, and then you can also earn these steady cash flows from a dividend or whatever profits you make. And these are all advantages of stocks, rather than just putting it in a checking account or a savings account that's going to earn you like 1%. So these are the big advantages of a stock. And then also you have a retirement listed there at the bottom. And this is a big thing. Not enough people are prepared for retirement. I believe by the age of 30, the average number of saving, or average amount of savings in the U.S. is $0 for retirement. So this is definitely a very important topic, and a topic that I will cover in future videos, that I've also covered in past videos. I made a great video on Roth IRAs and investments to put it in those to plan for your retirement. So go watch that after this video. And why I put retirement here is because of the fact that it's very important. If you could put your money into an index fund and earn 8%, and adjusted for inflation, you earn about 6% on that per year. By the time you're 65, you're probably going to have a couple $1 million if you're being vigilant in putting money into your retirement account like that. So you want to be able to retire well. That's the whole goal of all this. You don't want to worry about working or money by the time you're 65 or 70 or whatever age you do decide to retire. So stocks can be really useful for that, not just individual stocks, but also index funds and mutual funds as a whole. So where can I purchase stocks? This is something you may be wondering after watching this video, and feeling confident about, you know, stocks you're going to potentially invest in. What you need to do is you need to open an account with a brokerage, and some of these main big name brokerages that you guys may have heard of. Perhaps the biggest one for a while when you're a younger investor would have been Robinhood, because of the fact that they were free. All the trading was free. You didn't have to pay anything per trade, and it used to, you know, that money would add up over time. So Robinhood was very good. Robinhood's still very good. Then you have companies like Fidelity, Charles Schwab, and E-Trade, and many more, you know, TD Ameritrade, whatever. There's all sorts of different brokerages that you can open up accounts with. And what you need to do is you need to apply for an individual account or retirement account or whatever kind of account you're wanting to make, and then you put money inside of this account, and then you can invest that money into a stock. Say you want to buy 10 shares of Apple. That's going to run you about $1,000, a couple thousand, 1,200 in that range, and then once you're invested in that, you could potentially earn the profits or earn parts of the profits that they have as a company, or you could ride the wave downward if they don't do so well. But at the end of the day, the stock market is usually going to go up. It's usually going to go up about 8% per year. So as long as you stick it out, you should be okay. And these are really just all the advantages of investing in stocks as a whole. And this is really just a basic breakdown of what stocks are. So hopefully you guys appreciated this video. If you did at any point enjoy something you heard or learned something in this video, go ahead and smash the like button. Also subscribe to the channel Lone Palm Media. We're going to continue posting videos like this, the real basics of the stock market, and we have other videos that we post as well, whether it's weekly recaps, stock breakdowns, or just news in general. So stay tuned for all of those. I really appreciate the support you guys have been giving me. In the comment section below, if there are any basic topics that you guys want me to cover in a future video, I'd love to hear them, and I will try my best to respond to you and get a video out as soon as possible. So once again, thank you for watching this video, and until next time, happy investing.